What's up, military millionaires? Today I want to talk to you about the downsides of stock market investing. Over the last few weeks, we discussed how to evaluate securities investments, some good and bad strategies, and now we're going to bring it all home with some of the downsides. Now, for the record, there are a ton of upsides to securities investing, but you can hear about those everywhere, and I don't see enough information about the downsides, which is why I'm focusing specifically on that in this video. Intro. Don't forget to smash that like button. And now, there are some great advantages to investing in the stock market. Over the long haul, the market seems to average about 7% returns, which actually seems to be going up over the last little bit, which are pretty solid. Now, at that rate, your money will double just about every decade. And if you start investing when you're 20, that first dollar will have doubled 4 times before you reach 60. That means that for every dollar you invested when you were 20, it should be worth around $8 when you turn 60. Now that's a lot of opportunity when you scale that amount of money to include more money invested, and hopefully you put in more than $1 when you were 20. Now, stocks can also be extremely simple and do not require nearly as much work to manage as a real estate portfolio could. So all in all, the stock market definitely has a place in your portfolio. Nonetheless, there are a few things that aren't my favorite about the stock market, and it is worth discussing them here to ensure that you're getting the full picture. The first is taxes. Now, I already talked about capital gains tax in the day trading section, but just for you to be aware that securities investing has very few, if any, tax advantages outside of tax advantage retirement accounts. You can't write off depreciation against your income like you can in real estate. And you can't take advantage of 1031 exchanges to mitigate your taxes either. There are also some fees that I'm not a huge fan of. So depending on the method of securities investing that you choose, there could be some pretty costly fees associated with your trades. So you need to understand all of the fees that you will accrue and analyze how that will affect your returns over the long haul. I also don't like that you can't leverage, right? So you can't get a bank to lend you money for investing in the stock market. Now, that's not necessarily a bad thing, but it is an advantage that real estate investing has over securities because they don't. So when you buy a property, the bank will lend you money, which allows you to buy a larger property and benefit from returns on a larger investment than your personal cash would have paid for. In the stock market, if you have $10,000 you can invest, but you can't use leverage, so you'll only reap the return on your $10,000. So another issue is that people are emotional. You may run into this with the stock market. A company could be doing incredible and still have the stock value drop if the public opinion of that stock goes down. A prime example of this, and one of my favorites, is Tesla. In September of 2018, Elon Musk, the guy who owns like everything, including Tesla, smoked a blunt on the Joe Rogan podcast. And the next morning, Tesla stock dropped 9% in value because the public opinion of that incident was negative. Now, the stock recovered, but that is a pretty large dip in the value of your stock portfolio from something that you had no way to predict and no control of. So on the flip side, the Tesla stock tripled in 12 months over the last year in 2018 or 2019, 2020, and I haven't been able to figure out how their earnings warranted that. So I don't know what happened, but all of a sudden, whoop, goes the Tesla stock, and I can't figure out why, right? I guess public opinion swayed, whatever. So I'm not a huge fan of the fact that securities can fluctuate up and down this much without you having any control. So one of the reasons I like real estate is that I have at least some control of whether the property goes up or down in value. There are renovations that can be done, rent that can be raised, tenants that can be vetted, etc. So yes, things can always go wrong in either market or any investment, but at least I have the control, or at least some control, of the asset, which is something of a turnoff for securities investments because you have no idea, right? Things can happen that you can't control. All right, I've said this before, I'm gonna say it again, you won't beat the market. Now, is it possible to outpace the market's return? Yes. But is it likely? Not so much. Look, there are very few investors that can countlessly earn better returns on investing than on their own than the market. There are investors that can do it, but they are usually professional investors who dedicate an insane amount of time to studying the ins and outs of the market and companies and everything. So the odds are you probably don't have this much time. And if you do, you're probably not watching this. You're probably already doing it, right? So you don't have this much time, and although you might get lucky, over the long run, you won't beat the market, or at least not by much. So spending hours and hours and hours studying the market and watching every investment only to earn a few percentage points better, it's just not worth it in my opinion. Now, unless you have hundreds of thousands of dollars or millions of dollars in the account, 1 or 2% is really not that huge of a deal. So, I mean, it will be over time, but again, you're probably not going to beat it by time. So also, don't fall prey to people who sell expensive courses claiming that they can teach you how to beat the market. Not unless they are willing to show you their tax return and or personal transaction history, which I've said before. But look, I know way too many people who sell these courses and don't actually make a lot of money trading. I want to give you guys a wild example. Now, hopefully this will keep you skeptical enough to avoid these ploys. But I once heard a story about an investor who had an email list with 10,000 subscribers. He emailed half of his subscribers to say that stock XYZ was going to go up in value and that they should buy, and he told the other half that XYZ was going to go down in value and that they should sell. And the next day, XYZ did go up, and the 5,000 subscribers who had gotten the correct email were happy. The investor then ditched the 5,000 people who he had sent the bad information to. Right? So the next day, he did the same thing. He sent an email to 2,500 people saying that stock ABC was going to go up in value, and 2,500 people that stock ABC was going to go down in value. And again, one of these predictions was correct, and he scrubbed the other 2,500 people from his list. Now, he did this 3 more times until he only had 312 people left on the email list. Now, all 312 of these people have seen this investor accurately predict 5 stock trades that could have made them a decent amount of money depending on how much they invested. So next, the investor sent the remaining subscribers, those 312, an email about a very expensive course he's selling to teach them how he predicts these stocks and what was going to happen, right? So a lot of these email subscribers bought this course because, I mean, in their minds, he had a great gift at predicting what a stock will do because they'd seen him do it correctly 5 times, which could prove extremely lucrative to them. Now, the 9,668 people who had received incorrect emails were weeded out of his list, so the only remaining were the people who were convinced that this investor had a gift for picking stocks. Now, in reality, he had been guessing, I mean, at least on some level, and using the results of his random guesses to fool innocent people. Now, unfortunately, these things happen. Don't fall prey to this kind of stuff, and know that if the returns sound too good to be true, they probably are. It's also worth noting that this isn't the norm, and you can definitely make money with stocks. Just be smart about who you take this advice from. These kinds of guru schemes exist in the real estate world and with every other investment strategy too. So just make sure that you do your due diligence before investing a lot of money into any given strategy. Now, if you've been following along with me for any amount of time, you know that real estate is my bread and butter. And that being said though, I have a large amount of money in the thrift savings plan and some money invested in individual stocks and especially dividend stocks. Now, I can certainly understand the allure of securities investments. And if you really want to learn more about this, smash the like button and let me know. I'd be happy to talk more about this stuff. I am somewhat knowledgeable. I'm not an expert in this field, but I do understand the ins and outs, and I have, again, been trained by the military as a command financial specialist, so whatever, I'm down to talk about it. Just know that these are some of the downsides. There are tons of upsides, but make sure you're aware of these because the most important thing with investing is to never, 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 never lose money. So don't lose money, understand the downsides, understand risk, and don't do it. I hope you guys enjoyed this video. Don't forget to subscribe. Have a great day.